USD/yen has been pressing against its 3-month high for days, and it cannot close above it. The pair keeps touching that ceiling and pulling back. Which means right now, 3 separate indicators, Ichimoku, Bollinger, and RSI, are all aligned at the same inflection point simultaneously. That almost never happens.
And when it does happen, in my experience, the move that follows is significant.
Significant in both directions. That is what makes this particular setup worth paying close attention to.
Let's walk through each indicator. Because the story they are telling together is not the same story any one of them tells alone.
The cloud is the context. Everything else sits inside that frame. And right now, the cloud tells you this pair has been in a sustained uptrend for months. Price is sitting well above the cloud, not just touching it. Above it.
That's the part people miss. When you are above the cloud by that margin, the cloud is not resistance. It is a floor, far below. Sellers would need to push this pair down significantly just to test that support.
Agreed on that part. But here is what I want you to look at. The Tenkan line, the faster line, is above the Kijun. That alignment is bullish. It says short-term momentum is tracking in the same direction as the medium-term trend.
So the Ichimoku picture, at face value, is constructive. Trend is intact, lines are aligned, price is above the cloud.
At face value. That is the key phrase.
Now the Bollinger Bands. And this is where it gets interesting. The bands have been tightening.
A squeeze. I love a squeeze. Energy is compressing. When it releases, you get a directional move, and the trend context from Ichimoku says that move should favor the upside.
That is one interpretation. Here is another. The upper Bollinger Band is sitting right at current price. The pair is pressing against the ceiling of its own volatility envelope. Every time price tags the upper band and the bands are narrow, you are either about to break out, or about to reverse.
And right now the band width is meaningfully below where it has averaged over the past 3 months.
Which means the compression is real. This is not noise. The market has been going sideways and the range is shrinking. Something has to give.
And when momentum is already pointing up going into a squeeze, the resolution tends to follow momentum.
Tends to. Not always.
And then there is the RSI. Which is where I want to spend a moment, because a lot of people misread this.
RSI is sitting in overbought territory. I know what you are going to say. Most people see that and think the trade is over.
Because in many markets, it is. When RSI pushes above 70 and holds there, you are usually in the late stages of a move. The fuel is burning out.
But USD/yen has a history of staying overbought longer than it should. In FX, especially in a trend driven by rate differentials, RSI can stay elevated for extended periods. It is a momentum gauge, not a timing tool.
Exactly. RSI at these levels in a trending dollar pair is not a reversal signal. It is a confirmation that buyers are in control.
Until they are not. And here is the risk that the other 2 indicators cannot tell you. This pair has a ceiling that is not on any chart.
The Bank of Japan.
Every time this pair has pushed above 160, the verbal warnings have followed. And those warnings have teeth. When Japan has intervened in recent years, the moves were not small adjustments. We are talking about interventions on a scale that caused several hundred pips of downside in a matter of hours. Some of those episodes were among the largest single-day yen moves in decades. That is an exogenous risk. Ichimoku cannot model it. Bollinger cannot measure it. And RSI cannot price it in.
The chart looks clean until a central bank walks into the room.
That is precisely my point.
So here is where we are. 3 indicators, Ichimoku, Bollinger, RSI, are all reading this pair as strong, compressed, and leaning upward. As of this week's close, price is at 161.28. The 3-month high is 161.46. The Bollinger upper band is just above 161. The cloud floor is down near 157. RSI is at 78.
The setup is there. A break above the recent high, on expanding volume, with RSI holding, that is the continuation play. The Bollinger release to the upside would confirm it.
And if it fails here, if price stalls at the upper band while our SI starts to roll over, you have a textbook double top forming right at the edge of the breakout. The downside target then becomes the Kijun line near 159.9. A break of that puts the cloud back in play.
Two paths, both technically valid. What separates them is the catalyst, and that catalyst may not come from the chart at all.